Okay, good morning. Can you all hear me? 23 students. Can hear, can't hear. Okay, all right. So today, thank you. Thank you for responding. Very good. So today there's nothing much. We're not doing a lot of no calculations. We're only doing theory here. We're doing governance and corporate control here. Okay, on chapter 33 from your textbook. All right, so let's look at what are we going to talk about today. Very straightforward. It's on the slides. So you see, question number 1 here: do Japanese investors play an important role in corporate financial policy and governance? If not, could they? Okay, so the question here is asking: do Japanese investors play an important role in corporate finance? So, so in Japanese, there's a form of corporate governance called keiretsus. Okay, keiretsus. So this is a network of companies. All right, this network of companies are being structured around a bank. Okay, so basically it's like a flow. The bank are supplying finances to all these companies, okay, or this group of companies under this bank supervision. So this bank here is like the big brother here, okay, that supported financially to the companies under them. All right, okay. So what does it mean here? They are cross-holding here, right? The members of the Keiretsu may have holdings in each other's stocks. So this network of company will be holding each other's stocks. Okay, and all of them will be having a long-standing business relationship with one another. So all of them are interrelated, right? They're like a brotherhood here. Okay, they are like a brotherhood here, being financed by the same bank. Okay, and they're each other having stocks from each other's corporation. So maybe A will give B some, B will give C some, C might be holding A some shares, and so on and so forth. So this is the Keiretsu. So individual investors hold relatively little common stock directly. So that means general public. Okay, general public, you, me, and all those random fellas who are not in the organization will have very little holdings. Okay, very little holdings to the public. So also the cross-holding of stock by Japanese companies limit the opportunity for individual to play an important role in governance. So that means an individual very hard to be a major shareholder. You cannot go inside there. I cannot obtain sufficient share from the external and go inside there to be board, to be board of directors or the management team. All right, this is the downside of Keiretsu. Okay, so let's see what are the advantages and disadvantages of Keiretsus. So you see, the first one, the advantage here is internal financing from banks and other financial institutions within the group. So the banks and the FI inside the network of the company will definitely help their own people. They're the brotherhood. They will help the company. So you have a lot of fundings here. Okay, a lot of internal funding. You could also avoid external financing. Okay, so you need to take any you need to issue any debts, any bonds. Okay, so lower transaction cost there. Everything is financed internally. Stable cash flow. Okay, very strong cash flow. Low financial distress incidents. Of course, when you have stable cash flow, strong internal financing, the financial distress will be very little, very minimal. Takeovers are rare. Okay, takeovers are rare. So because the external public got very little exposure to the organization, so it's very hard for them to take over also. Okay, and then the disadvantages here: ordinary shareholders has very little influence. So this is the rest of the common stockholder lah. So they got very little influence, basically, or maybe even negligible. They might not be even be able to make any noises. Lower dividends. Okay, lower dividend. Higher agency costs. So as you all know, I think you all just recap back what is agency cost here. All right, different goal between the management and also the owners. So over here, because a lot of them are internal people, are friends, okay, we call them friends, they will have their own agenda, they have for their own wants and needs. So there will be a lot of agency costs here where they will be playing according to own interest instead of public interest. All right, so there's a higher agency cost. All right, that's for part one, Karatsu. So now, the second question here, okay? Second question here is talking about transparency. So there are three questions in total here. The first one, they ask you, why is transparency important in market-based financial system? Okay. Second, why is it less important in a bank-based financial system? Market-based financial system. And after that, bank-based financial system. And lastly, what kind of industry do you think should thrive on market-based financial system or in the bank system? Okay. Let's go. So bank-based system and market-based system, let's look at the differences here. So banks have long-standing working relationship with companies seeking finance. So because bank is more towards relationship-based, okay, it reached to a level which is more, what do you call that? It's closer to the customers. Again, banks have long-standing working relationship with the company seeking financing. So if you're going to take loan from the corporate loan or corporate or whatever loan with the banks, they know you. They have a relationship with you. They clearly know who are you. Okay. Next, banks have an ongoing information about the firm. So if I ask for loans and whatsoever, they know who are you. They got your secrets, they got your CITOS in Malaysia. So they know who are you. So for companies, they will check your RAM status, your ratings, and so on and so forth. Okay, so they know, or they have information about you. All right. So market-based system, creditors and equity holders require the financial information about companies seeking financing be available. So they need your information, your financial information, your financial statements, your annual reports. All right. Okay. Sufficiently detailed and accurate if they are to participate in the market. Okay. So when we talk about bank-based system and market-based system, some of you are still lost. What do you mean here? So bank-based system means you are getting money from bank lah. Okay, means basically from getting loans. All right, market-based system is more towards money market funding. Okay, getting money from the market. So it's should be considered more like issuing stocks and etc. So this is on market-based and bank-based. So there's more on market-based here. The information included financial statements, like what I tell you just now. Okay, so this is to allow participants in the market to make judgment about the firm's profitability and prospect for the future. Okay, investors will be heavily relying on the financial statements because that's where they make the decision whether should they trust you or not, or to have a little knowledge about your organization at least. But banks, they don't need to go through this stage. Okay, they don't need to go through this stage. They got more information. All right, they have the more direct information. Okay, they have the more specific information for them to judge you. Okay, or for them to weight your risk. All right. So, what kind of industry will use market-based and what kind of industry will use bank-based? Usually, new industry seems to develop in market-based financial system, such as the US. Okay, in the US especially, new industry will take market-based financial system. All right, they like to be listed, they like to get the money from the public. Okay, bank-based system, Japan and Germany. All right, they are very successful in sustaining established industries. Like we mentioned just now, in Japan, there is called something called Karatsu. The Karatsu is basically being built around bankings. Okay, so banks has been their major support here. All right. So the automotive industry, for example, grew and developed in the US, but Japan and Germany have sustained a competitive advantage in recent decades. So back then, automobile started in US first. US boom on automobile, very strong. Then after that, it shifted to Japan and Germany. Okay, they started to grow strong in industry also, in automobile industry also. Okay, you see all the big brands in Japan now that you know of: Honda, Toyota, Nissan, Mazda. In Germany, including Mercedes-Benz. So, as new industry or product develop, they often appear to be several potential avenues for development, each requiring significant amount of financing before the industry leaders emerge. So, as a new industry or new product in the market, they need, all right, a certain amount of finance to support them, to let them grow. Okay, even you see, you take example as Malaysia. Malaysia used to support a lot, not used to, like even now, okay, support a lot in their automobile industry. But it seems like our automotive industry could not be a competitive advantage yet. Okay, it is still being supported because they did not emerge as a leader or did not emerge near any part of the world yet. All right. So these are some of the corporate governance here that we can talk about. Okay, some internal control of organization. They could use bank-based system, or they could even use the market-based financial systems. Okay. So further on, a bank-based system is not likely to provide early-stage financing. Okay, because the uncertainty involved. When they are not sure about the risk, the bank won't give you money. But a market-based system provides financing from numerous investors with different view regarding prospect for development. So one good example for you to take into this, do you think if you're starting a crypto business, a crypto company, a crypto organization, do you think that the bank will support will give you any financing or not? No. Again, they cannot give you. So what crypto owners will do, or these crypto builder, inventor, they will seek for public investors. They seek for fundings. Okay, so when they get the funding, those people believe in your dream or your idea. They do fund. They give you the fundings. They give you the money, the initial investments, and this is the difference between a market-based and a bank-based system. Okay, bank-based looking at your results, looking at your collateral, looking at your risk there, but market-based looking at your potential. All right. So lastly, market-based system seems to be more effective in eliminating declining firms and industries. Okay, so they see that firms and industries which is not strong anymore, which is no potential anymore, they don't support it. They don't invest into it. Okay, so it's very effective on eliminating it. So for example, we take the crypto market again. All right, this is a hot topic. It's a trend now. Everyone is talking about it. Everyone is crazy about it. So if you are a crypto which has you're creating a blockchain or a coin which is not much of not helpful, or not define, don't have a purpose, or the purpose is not significant impacting the public or community. So the public will assume that you are not good enough. They won't support you. They won't provide you any funding, and you will eventually die off. You can't compete anymore. Okay. So I think this example could use it for you to relate it for now on the difference between market-based and bank-based. Okay. Since crypto is a very trending news now, you see it everywhere on Google News, on Bloomberg and wherever. So it's a hot topic. So we could relate to that in that case. All right. Moving on to question 3 here. Question 3 asks us, what are the costs of concentrated ownership? In other words, it's called family-owned business. Okay, do you think there is a degree of ownership concentration that is just right, not too high or too low? I explain. So do you think that there is a potential of ownership concentration? Just right. Not too high, not too low. This is what they're trying to tell you. So the hint here, think of the status of minority shareholder. Okay, one of the problem that arise due to concentrated ownership of family-owned businesses, it will cause us some issue to the minority shareholder. Why? Let's look at it now. Here, here is the list of agent ownership. Number of firms in sample. That one is spelling error. Not maple, it's sample. Okay, so there are few countries here being taken in Asia as studies. Okay, you see in this country including Hong Kong, Indonesia, Japan, Korea, Malaysia, Philippines, Singapore, Taiwan, and Thailand. So the number of firm in sample, the family size, the state-owned, widely held by who, and percent of assets controlled by top 10 families in the country. So if you look at this table here, you can see in Indonesia, there are 57.7, all right, of the major organization or major company owned by the top 10 family. Okay, next high one is in Philippines, then followed by Thailand. All right, this shows that almost 50% of the organization in these three countries are actually owned by family members, families. Let's look at here. Out of the sample of the study, okay, out of the sample of the study, you can see that most of the Asian countries has more than half or near half of the organization owned by family, other than Japan. Okay, other than Japan. Japan got the lowest, 9.7% only. Okay, 9.7%. The highest here you see owned by family members. Most of the firm will be Indonesia, Hong Kong, Malaysia. Malaysia is in the chart also. Okay, Thailand also very high. 60% over of the firm of this study. This study is not study all the firm in the country. Number of sample only. Okay, take a certain number of the sample. These are the percentage of family owned. There could be bias in this study. I'm not sure. This study taken from where. Okay, it was given by your lecturer. So if based on this study, it shows that indeed in Asia, there are a lot of countries in Asia, and most of the organization, or more than half of the organizations, are owned by family members. Okay, other than Japan. Only Japan a bit different. Japan got the biggest sample also. Okay, and the family owned is also the lowest. All right, it's owned more by the public, 79.8. Okay, so this is just chart. Now look at it. The implication of concentrated ownership, so of family-owned businesses. Okay, so concentrated ownership reduce the influence of minority stockholder. How is this happening? Of course, what? If you're a minority stockholder and most of the major stockholders are owned by family member, would they prioritize you or not as the minority, or they prioritize the family, the family goals? All right, so you can see they will definitely appreciate the family goals, the family achievement together instead of a minority shareholders. Tempt managers and block holders to shift value to their own pocket. Who are block holders? Majority shareholders, the biggest shareholders. Okay, so managers and block holders tend to shift value to their own pocket. That means they take things into their own hand because it's family owned, right? Okay, it's all about the strong bond, the family bond, the relationship, right? So everyone will have their own greed here. Okay, they will value their own self. They want value their own benefit here. So it's very tempting for them to shift the earnings into their own pocket. Ideal ownership concentration, where block holders are large enough. This is the ideal. Okay, just now there's a question that asks you which one is too much. Should it be too much or too low, or is there a perfect spot or not? So a perfect spot is actually where the block holders or the largest shareholders are holding sufficient share to monitor the company or to at least secure the ownership of the company. Okay, in other words, it's enough lah for you to monitor your managers and limit the agency cost, but not too big until the minority stockholders' rights are eroded. So it cannot be too big until the minority stockholders could not participate in the organization decision making. So it could be big enough for them to control, but not too big until there is no more rights for minority shareholder, or too small for them. Again, or too small for them. So for example, just now you can see some of the, from the chart there, you can see widely held means public. Okay, so in this case here, Korea is playing a very good positioning. Okay, look, if you imagine that organization, in an organization, 48.4% shares are held by family, the balance are held by public. This is not too bad. This is okay. This is quite equal. They can control at the same time. The minority can still make noise. Okay, the minority can still make noise. Let's see which country. Yeah, you see, like in Thailand, 61.6 family owned, widely held is only 6.6%. So basically, the public is holding around 6.6% only. 61.6 versus 6.6. So very small one. No, it's negligible. It's near negligible. They cannot even make any, cannot even say anything. Indonesia also, you can see. All right. Okay. So they cannot make any influence. The organization will control everything. So that's what it means lah. Here, you need to have a large enough to monitor the managers and limit the agency cost, but not too big until the minority shareholders are being neglected. Okay. So these are the implications of family-owned business, or yeah, this is the benefits there just now. Okay, we continue. Greater stewardship role. Again, there's loyalty and commitment, longer-term view to business. That means they are family-owned, right? So all of them are having the same goal, like I mentioned just now. So there will be a stronger perspective or stronger milestone for the company. So financing from company within the group, less chance of financial distress because all family members, they support each other. Access to labor available within group and more flexible. Okay. Interests of family align with shareholders because the shareholders are the family. Culture of paternalism, trust, and altruism. Okay, you can read this yourself. The problem here, lack of succession planning. Okay, because all family goal ma, so very lack of planning. Nepotism, definitely. Okay, nepotism. Possibility of greater risk aversion. They're scared of risk. And higher agency cost, for sure. For sure, there will be higher agency cost because less transparency in terms of disclosure to minority shareholder. So everything also controlled internally, everything also solved internally. So there will be a very high agency cost here. Okay. Moving on to question 4 here. Question 4 here is basically talking about globalization. So first part of question 4, globalization means, among other things, more international, among other things, more international trade, more direct competition among companies in different countries, and more MNCs. Okay, with globalization, that means it's more international transaction, more competitions from different countries, and more MNCs are being built. So second part, do you think, okay, do you think that globalization will lead to convergence in system of corporate governance? What is convergence? That means with globalization, there will be a standardized system for corporate governance. Everyone will reach to a certain equilibrium. Convergence means equal. Okay, or do you think that international differences in corporate governance are backed in by history and differences in legal and financial systems? So there are two choices here. Will because of globalization, corporate governance will be equal everywhere, or do you think that there is still an international differences because they are based on their own individual history on legal and financial system? So let's look through it. What is it? Okay, form versus substance. Based on the research from Kana Kogan and Palepu, they find that economic integration correlates with common standards. Okay. However, there is no evidence of convergence in how governance actually works. So governing and control did not reach convergence. Okay. But economic integration correlates with common standards. Okay, or with common applications. All right. So next one is more convergence expected among large and multinational company than for company that do most of their business locally. So yes, indeed there is some convergence in international, okay, or in a multinational company as compared to a domestically owned company or locally owned businesses. Okay, it's just yeah, this is there's some significant impact here. Okay, there's some sign here being shown that there are more convergence among MNCs. Next, large differences in ownership and control between countries that have similar financial system. So company, okay, that have similar financial system also have differences in their ownership control. So it's not typical. It's not basically. So in other words, is trying to tell you that the financial system is not really related to your history and what is the legal system of a country. Because from this study here, it shows that there's still differences in ownership and control between countries that have similar financial system. Okay, that means it's not being influenced by the legal and financial system, as mentioned from the question just now. So, last question here: do you think that the international differences in corporate governance are baked in by history and differences in legal? So, this is no. Okay, there is no evidence on it. All right. So, the last one here, you see the chapter on Canada in Randall Mock's book. Canada and US have similar Anglo-Saxon financial market, but ownership in Canada is much more concentrated or much more family owned. Okay, so it's nothing to do with the financial system. All right, so clear, and that's it. Yep. Okay, and that's the tutorial for today.